Today, I'm sharing with you the 5 top ETFs that will make you rich. Oh yeah. I'm also going to share a $2.1 million investment portfolio a little bit later in the video, but first I got 3 questions for you. Number 1, do you want to build a $1 million portfolio in the future, but you're not really sure where to start? Number 2, do you stress out about money and you wish there was a way that you could build up something that you don't have to worry about money in the future? And number 3, would you like to have the freedom and the power to work when you want or if you want because you've built up the right type of financial freedom? Well, if you answered yes to any one of those, listen up for today's top 5 ETFs. Now, diversification, it's pretty awesome. Because let's say, for example, you decide you want to invest all your money into company ABC. So you put in all your hard-earned money. Well, then all of a sudden, guess what happens? Company ABC takes a nosedive. It goes out of business, it goes bankrupt, which means you lose all of your money. But see, with an ETF, you own the basket of stocks. So even if company ABC goes out of business, sure, the ETF might drop a few dollars in price, but it's going to replace that company with another company within its index that it's tracking. And that's what's really cool about it. But I'll tell you what, I'm not going to waste your time with just saying, hey, here's an ETF, it's called VTI, and it tracks the total stock market index. No, we're going to do a little bit better than that. In today's video, I'm going to share with you 5 growth ETFs. And I did a little bit more research on these. These are ETFs that are actually focused on growth that have beaten the S&P 500 total return over the last 5 years. Let's get started with number 1 on the list. And the first one on the list is ticker symbol VUG. That is the Vanguard Growth ETF. Let's talk a little bit about it. This ETF invests in stocks of large cap companies. For example, you're going to see companies such as Apple, Microsoft, Tesla, Google, and they're going to be made up of companies that are experiencing major growth. The fund holds over 256 different stocks or companies within its index. The total return over the last 5 years for VUG was a whopping 79.43%. So that represents like 15.9% growth on average each year over the last 5 years. Now tell me what savings account, tell me what different other options are going to return you 15%. Wouldn't it be great if your job gave you a raise of 15% every single year? Sure, if you got a promotion every year, that would be kind of cool, but 15% is a lot, and it beats inflation and beats all that other crap. So that's what is so exciting about the future potential growth of the stock market, of ETFs, and of investing in general. Now, this does have an expense ratio of 0.04%, which means for every $1,000 that you have invested into this fund, 40 cents will go toward the expenses. If you're wondering how to calculate the expense, all you have to do, go over to a site like Seeking Alpha. It'll show you the expense ratio on the right-hand side of the page. Take that, and then you type in whatever you're investing. In this example, we did 1,000. So I'm going to pop up $1,000 right here on your calculator. You're going to multiply that by whatever the expense ratio is. In this case, we're talking about 0.04, and then you're going to hit that percentage button right there. Boom, that'll convert it into a decimal, hit equals, and that is what the answer is. So anytime you want to calculate that, just look at whatever your overall investment is, multiply it by the expense, and don't worry, they don't send you a bill. It just comes down to your portfolio balance every year. Let's move on to number 2, ticker symbol IMCG. This is the iShares Morningstar Mid-Cap Growth ETF. Now, unlike the large cap funds that we looked at in VUG, IMCG, they focus on mid-cap stocks. These are medium-sized companies that have a market cap or market value between $2 and $10 billion with a little bit of growth potential mixed in. Now, you're not going to find the same type of companies that you'll find in the other ETFs today. You're not going to find your typical Apple, Microsoft, Google. Instead, you're going to find over 334 different companies such as the Hershey Company, Workday Incorporated, Ross Stores, ON Semiconductor Corp, and a few more. Total return over the last 5 years is a nice whopping 80.79% and has an expense ratio of 0.06%. So that means 60 cents for every $1,000 invested. Now let's move on to number 3. Now number 3 is the only one in today's list that hasn't beaten the S&P 500 over the last 5 years is total return because it tracks the S&P 500. And that is VOO, the Vanguard S&P 500 ETF. And even though its 5-year total return is still awesome at 69.43%, and what it's going to do is hold the companies listed within the S&P 500. We're talking about 500 of the largest companies listed in the S&P 500. Expense ratio, super cheap, 0.03%. That means for every $1,000, 30 cents would come out of the expense ratio. Holdings of this fund include things like Apple, Microsoft, Berkshire Hathaway, ExxonMobil, and so many more. Now, as of the recording of this video, the ETF price for one share of VOO is $377. And that seems like a lot, right? Like if you want to buy one share and you don't have $377, you're not going to be able to buy a share. And that's kind of disappointing, right? But don't worry, you can invest in fractional shares. That means if one share today costs $377 or more, or whatever the price is when you buy your ETF, you don't have to put in that amount to own a full share. You can own that fractional share, put in $5, put in $10, put in whatever you can afford. And the most important thing is have a process, have a consistent plan to invest consistently, whether that's weekly, monthly, daily, whatever you'd like. In fact, over this last year, starting in January of 2022, I decided to invest $5 every single day into the S&P 500 using VOO. And I did that using Robinhood's Invest In app. It's super easy to use and you can set it up to be automated. So check it out. I'll include the link to Robinhood as well as a link to that video if you want to check out the details behind investing $5 every single day into VOO. And what's really exciting, as of the recording of this video, I now have growth up to $40. That means everything I invested, I have an additional $40 thanks to the stock market going up. It's a good thing. Moving on to number 4. This one is MGK. It's another Vanguard fund, but this one is the Mega Cap Growth ETF. Now there's only 99 total companies or stocks in this ETF because the stocks and the companies in this ETF have to be mega. This means you're going to see some similarities to VUG, but it's going to be a little bit more on steroids. You know, Apple, Microsoft, Amazon, Google, but the percentage of allocation, which means every time you put $1 into the fund, it's going to separate that dollar across all the different companies in the ETF, but the allocation of MGK is going to favor these companies a little bit more. You can see we have Apple at a higher percentage in MGK versus VUG because one, MGK holds less stocks, 99 for instance, and it's going to focus on mega cap. The more mega your capitalization is, the more you own of the stock market. In this case, Apple is one of the biggest companies. It's going to favor that and put more of the money toward that particular company. So that's how it weights and ranks its allocation. The total return over the last 5 years, a whopping, exciting 82.42% with an expense ratio of only 0.07%. And again, if you take that 82.42%, you divide that by 5 years, that's an average growth rate of 16.48%. If you could just invest all your money into this, and past performance does equal future performance. It doesn't always. Of course, there's always a lot of risk in the stock market, but if it does, I don't know any company that gives you a 16% raise every year. So imagine just putting all your money into that and seeing that growth over the long period of time. That's why I love investing so much. And I also want to say, why were we not taught about all of this stuff in high school? What's going on there? Like, why don't they teach us stuff? So much more important than parallelograms, man. So hang tight. We're about to get to the exciting part where we calculate the portfolio and show you all the exciting things, but let's move on to number 5, and that is none other than QQQ. This particular ETF is a little bit different. It tracks the Nasdaq 100, the top 100 non-financial companies listed on the Nasdaq exchange. Now this one's the big dog, the big cheese at 109% in total return over the last 5 years. That's absolutely remarkable. Total of 102 holdings within QQQ, and the expense ratio is going to be a little bit on the higher side compared to the other ones that we looked at 0.20%. That's $2 for every $1,000 invested. So all of these are just really exciting growth potential ETFs. But let's talk about the exciting part, right? Let's put it on the portfolio visualizer. Let's take a look at how this all works. Now, first thing I want to show you is over on Seeking Alpha, one of my favorite research tools for ETFs and stocks. What you're looking at in this case is we have the S&P 500 right here. And over the last 5 years, you can see the S&P 500, AKA, I'm gonna call it the stock market in this case, returned a total of 75.5%. That's really exciting, that's really good. And now look across the board here at all the ETFs that we explored in today's video. Look at the growth. We have QQQ in first place at 103% growth, beating the S&P 500, followed by VUG, beating the S&P 500. Of course, VOO tracks S&P 500, so it's not going to beat it, but then followed up by IMCG, beating the S&P, and MGK, beating the S&P as well. So as you can see, as indicated by all these different colored lines, it kind of shows you what you're looking at. You can see the S&P 500 down here below all the other ones, and which one's here at the top? Of course, QQQ leading the way. Now that doesn't mean though that you should just run out there and invest all your money into QQQ. See, you got to still do your own research. I'm not a financial advisor, and again, we don't know what's going to happen in the future. Dumb things could happen in the future, and that could be bad. So let's hop over to Portfolio Visualizer, one of our most exciting things to do here. I'm going to push the limit, and I know a lot of people don't like this, but I got to push the limit a little bit. The average car payment in America right now, $777 as of the recording of the video. Way too much money for a car payment. So what I would challenge you, if you're really serious about this and you want to have that millionaire portfolio, you want to focus on your future, you want to focus on getting out of financial stress, everything we looked at the beginning of this video, start thinking about, okay, how can I reduce some of the expenses that I don't really need? Because I'm not going to buy that car to impress people I don't really like. Instead, I'm going to buy a cheap car that I can pay off and then ride that car with no debt payments at all, own the car fully and run it until I run it into the ground. Then I'm going to take all that money I would have spent on the car payment and I'm gonna put it into the stock market instead. So that means I'm gonna up the ante to $1,000 a month. Just do it. You know, figure it out. Here's what we got. From the year 2007, when I personally was looking at trying to invest, right? I was like, I really want to start investing, but I was dumb. I bought a dumb car and I bought a house that I couldn't afford. So I'm speaking from experience. It was a really stupid idea. I shouldn't have done it. But if I would have done this instead, from the year 2007 until 2023, invested $1,000 every single month. And what I'll do here is I'm going to pick like 3 of them. We'll pick QQQ. We're gonna pick IMCG, and we're gonna pick MGK. And that's 100%, we have 3 different portfolios in today's visualizer, and I'm gonna analyze this portfolio. So we're gonna look at the difference between January 2008 and January 2023, investing $1,000 every single month. Staying consistent, here's what it looks like today. My portfolio balance in QQQ is $758,000, IMCG $549,000, and look at MGK at $595,000. And that's a short period of time if you really look at the grand scheme of things. Look, I'm not gonna let the next 15 years look like the last 15 years. I'm gonna go all in on really building this up, even if that means I gotta like focus on some different ways to make extra income or cut down my expenses. And I wanna challenge you to do the same thing if you're serious about growing your portfolio. Now, let's just say we did only QQQ. And this is where that $2 million comes into hand that I talked about in the earlier part of the video. If you would have invested from the year that QQQ started, which was the year of January 2000, we're talking about 20 years of growth, but think about it this way. Think about your age right now, and I don't care if you're 50 or 60, think about your age right now, and I want to think positive that you're going to live for a long time. In the next 20 years, what does that look like, right? What does the next 20 years look like? If you're only 18, holy crap, you're going to be like 20 years from now. It's so awesome. If you can do your own research and find a fund at or similar to QQQ's past performance, again, not financial advice, but here's what happened in the past. If you would have invested from January 2000 to 2023, $1,000 a month, take a look at what would have happened. Your balance right now, as of the end of January 2023, would be $1.8 million. Oh my God, $1.8 million. And take a look at the peak. So if we go over to the peak here, when everything was really good back in 2021, $2.4 million. So let's say, you know, for example, you decided, okay, forget it. I'm selling everything, December 31st, Happy New Year's. I'm selling it all, and I have $2.4 million. Congratulations to you, because you have really done what a lot of people haven't done. Instead of buying the car, instead of going out to the debt, again, I'm kind of talking to myself here, right? I'm so disappointed that somebody didn't smack me in high school and say, you have got to get a plan together, and you got to think about how you're going to do this, especially today. Things are so much easier to invest today than they were years ago. So just think about that. Think about the excitement of what we're up against here in the future of how we can take this to the next level. Now, if you're ready to get started with even more, check out this video next, and we'll see you on the next video.